Hello, welcome to LCG's preview for the week ahead. I'm going to discuss interest rate decisions from the Bank of Japan and European Central Bank, Theresa May's Plan B for Brexit, earnings from Microsoft, and the World Economic Forum in Davos. Before that, I'll run down the biggest events in the economic calendar. On Monday, we have the rescheduled China GDP, retail sales, and industrial production. On Tuesday, Davos starts, and for economic data, there is UK unemployment and German ZEW. On Wednesday, there is the Bank of Japan interest rate decision and Canada retail sales. On Thursday, it's Australian unemployment, followed by Eurozone manufacturing and services PMIs, and the ECB rate decision. Then on Friday, it's German IFO and US durable goods. Moving on to the top corporate results to watch this week. UBS reports its full-year results before Johnson & Johnson and IBM report Q4 earnings on Tuesday. Comcast, Procter & Gamble, United Technologies and Ford report fourth quarter numbers on Wednesday. Microsoft, Intel and Starbucks report Q4 earnings on Thursday. And Colgate-Palmolive offers its quarterly earnings on Friday. Moving on to the central bank decisions this week, and in many respects, the ECB and the BOJ face similar situations. That's a lower pace of inflation and rather sluggish economic growth. And so both of those would suggest no rush from these central banks to raise interest rates. So the ECB just finished quantitative easing in December, so this is its first meeting since doing that. We've got a bit of a sense as to probably what they're thinking about the Eurozone. We did hear from Draghi, who gave a speech to European lawmakers on the 15th of January, basically saying he doesn't expect a recession. Those central bankers never do, obviously, but he does expect this slowdown to last longer than expected. So the takeaway being the Eurozone economy still needs this stimulus. So it doesn't have QE, but it does have 0% interest rates, or negative interest rates in effect. Why is that? Well, the Euro area economy, from our perspective, is just not as productive as the US. It's not been able to grow out of its problems. And so the ECB can't actually raise rates without suffering some damage. And so there has to be either acceptance that the damage is going to be there and they raise rates, or they just never raise the rates. And so we've got issues like non-performing loans, crowded out buyers of government bonds. So the government bond market could really suffer if the ECB started to sell down its portfolio, for example, or started really drastically raising rates. And governments are increasing their deficit spending. So actually, the governments owe more, have larger debt piles, and if you increase interest rates, it's going to put pressure on those governments. So if all that put together suggests a weaker picture for the euro. Obviously, you've got the dollar on the other side of things, and we've had a more dovish Fed recently, but still the economic picture in the US looks brighter than that of the Eurozone. Okay, moving swiftly on to Brexit. I don't want to talk about this too much, although it's almost unavoidable because there's so much going on at the moment. But the two dates to keep in mind here all relate to this Brexit Plan B. Obviously, Plan A got voted down pretty dramatically in Parliament last week. So now Theresa May is obligated to present Plan B on Monday, so that's the 21st of this week. But then MPs will have a chance to debate and vote on the Plan B on Tuesday, but that's the 29th, so over a week's time. So it's probably that 29th date where we actually get the changes to know closer to where we are. It's doubtful that Theresa May has any dramatic change in store for us just a couple of days later after saying her deal is the only deal in town. What does that all mean for sterling? Another spate of uncertainty. We did push up to 128. It's hard to believe with all this uncertainty around we can get much beyond the 130 handle unless we have some significant shift towards a second referendum. But that doesn't look like, we'll have that information probably closer to the 29th, not so much this Monday. Moving on to Microsoft earnings. So what was interesting about Microsoft this year is it became the most valuable company again, a title it hasn't held since 2003. Obviously, Apple held that mantle for most of the time, also Amazon a couple of times recently. The reason for it being that this shift to software as a service has made their revenue stream more consistent. They haven't had these quarterly jumps and people have it. These occasional jumps where everyone buys Microsoft Office for their computer upgrades, paying on a more regular basis. This is more comforting for investors and easier to assess on an ongoing quarterly basis how the earnings are improving. And they've also got Azure as a major source of growth via the cloud. An interesting quote from CEO Satya Nadella that clients tend to want to trust that they have a partner whose business model is aligned to their success. So a bit of a dig indirectly or fairly blatantly, I suppose, at Amazon, suggesting that while on the one hand, Amazon's offering the cloud services to support these businesses, on the other hand, Amazon is actually a direct competitor, particularly, for example, the big grocers or retailers. The other thing being that Microsoft is very diversified. Got a range of services from the likes of search, gaming, via the Xbox, etc. So it is a very solid, reliable company, and it looks like it has a source of growth through the cloud. So a lot of things to like about Microsoft. Probably its biggest risk, without knowing the exact specifics of the upcoming earnings before they've come out, is just the external environment and the general attitude towards tech stocks, which have come under pressure at the end of late last year, rallied a bit this year, but maybe a little bit overbought. I think whichever way tech stocks go, we see Microsoft still outperforming the other tech shares. I wanted to quickly mention Davos. The comments that we've heard in their statement before the meeting is that it's more urgent than ever to renew the architecture of international cooperation. So obviously that's what Davos is all about, is the kind of move to a more international, multinational society. But obviously the movements in particularly Europe, but also worldwide, including the US, but even in likes of Brazil, is more nationalistic, and it's really against the general ethos of Davos. So it makes the meeting interesting, although perhaps no direct impact on markets that we're going to know anything about other than through the private policies of the individuals who attend. Well, thank you very much for watching. Good luck for trading this week. And if you want to see these videos as soon as they are released, please follow LCG on YouTube and social media.